Guys and girls, welcome back to another Bumond Outlook's fundamental video, and today we are discussing correlations. Now, what are correlations in X? Correlations refer to the statistical relationship between the price movements of different currency pairs or asset classes. These correlations indicate how closely or inversely related the price movements of two currencies or asset classes are over a certain period of time. Now, it's important for us to understand that we have two types of correlations. We have a positive correlation and a negative correlation. Now, a positive correlation is when two pairs move in the same direction at the same time. They are said to be positively correlated. For example, if the euro-US dollar and GU pairs are moving in simultaneous upside, it's due to a weaker US dollar likely, and therefore they are positively correlated. Now, negative correlations is when two pairs or two asset classes move in opposite directions at the same time. Therefore, they are negatively correlated. For example, if dollar CAD is rising in value, you tend to see US oil fall because they're negatively correlated. The reason being for this is because likely the stronger the dollar gets, the less business is being done with Canada as less oil is being purchased. So they inversely correlate or negatively correlate. Now let's look at some examples of positive correlations. First, as we just discussed, the US dollar CAD and crude oil. Now the Canadian dollar CAD tends to have a positive correlation with crude oil prices. Canada is a major exporter of oil, so changes in oil prices can impact the value of the Canadian dollar because as oil increases in value, businesses in Canada are charging more for the oil, therefore they're making more money, more demand for the Canadian dollar, so on and so forth. So as US oil rises, dollar CAD tends to fall because the Canadian dollar is appreciating over the dollar. Now, Euro-US dollar and the DAX. Now, the Euro and the German DAX stock exchange or stock index can exhibit a positive correlation because Germany is a major economy within the Eurozone, and changes in economic outlook can affect the Euro and German stocks. GU or GBP USD and the FTSE. Again, the British pound or the sterling, which is commonly known as, and the UK FTSE may show a positive correlation as movements in the UK stock market can influence investor sentiment towards the pound. Now, be careful with this because at times, if the pound is very expensive, it may deem a negative on equities or the UK FTSE because it's going to, of course, cost a lot of money to do business with that economy. But more often than not, you tend to see a positive correlation. And finally, dollar yen and US Treasury bonds. Now, the US dollar and US Treasury bonds often have a positive correlation. When investors buy US Treasury bonds, they are essentially buying US dollars, which can impact the value of the dollar. So what you tend to see is as US Treasury bonds rise, dollar yen, of course, rises with it. And as US Treasury bonds fall, dollar yen falls with it as well. Now, here's some examples of negative correlations. Of course, the US dollar and gold. Now, when the US dollar is appreciating, you tend to see gold do the inverse and vice versa. This, of course, is down to majority of the time risk sentiment, but of course, looking at a correlation point of view, they negatively correlate. The reason being is when the value of the dollar strengthens, gold prices decrease because, of course, you need more dollars to buy the gold, so on and so forth. Now, Euro, US dollar, and of course, the Dixie. Now, we all know that the euro contributes to a large portion of the Dixie, and hence why the Dixie is essentially an inverse euro dollar. But as you can see here, the euro and the US dollar index are largely negatively correlated because when the dollar strengthens, it, of course, drags down euro dollar with it and pound dollar for that instance, and any dollar crosses and vice versa. So you can just see they are negatively correlated. AU, same thing applies to the Dixie. But an interesting one that we have below here is, of course, dollar CAD and gold. So as the US dollar inversely priced against gold, in other words, as the dollar strengthens, gold devalues, gold prices, reflecting what they're going on as well, of course, affect the CAD negatively as well. Now, the main reason for this being is usually dollar CAD is used as a risk-on indicator. And of course, as we can see, gold and dollar CAD inversely negatively correlate. Finally, euro, US dollar, and crude oil. Now, as the euro, of course, moves upwards or appreciates, crude oil will do the negative and vice versa. And here's why. Changes in oil prices can impact the global economic outlook. So the more expensive oil gets, the more oil increases in value, the more oil importers may be at risk of being negatively affected by this. So of course, as oil appreciates in value, the euro tends to weaken off slightly, and the inverse occurs. If the euro is aggressively rallying, we may see oil pull back a bit. Now, this is true, of course, to nat gas as well. Those are just some very basic examples of positive and negative correlations. Of course, a thumb rule is the stronger a native currency, of course, the more business they're going to be doing, the negatively other asset classes will correlate with them. It's important to understand where you get negative and positive correlations because it can explain some movements without, of course, understanding exactly where that catalyst is coming from. For example, if we saw US Treasury yields rising due to interest rate expectations increasing, it may explain why dollar yen, of course, is rallying so aggressively. It's not always down to the dollar or the yen scenario. It could be down to, of course, the yields aggressively pushing up. So once you understand your positive and negative correlations, make a list of them and let us know what you're spotting in markets in the Discord, and let's see what positive and negative correlations you're spotting yourself. Take care.